Hey, thank you, Apollo, for joining us today. When I asked Dimensional if I could interview a PhD and ask him some of these questions, my number one request was you. And the reason my number one request was you, because you are very, very gifted in taking the very, very complex in the finance and economics world and make it very, very understandable. So I really, really appreciate this. And like the founder of Dimensional says, making the world a better place. I know with the insights today that you're going to give us, we can make the world a better place and a better experience for investors.
Thank you so much, Eric, for the invitation. It's actually great fun. I appreciate the kind words, and I hope I can provide some clarity and cut through some of this noise and make investing a little bit less anxiety producing that the media might wanted to make it sound.
Absolutely. I thought it would be first to go over. Can you provide us just a brief overview of Dimensional Fund Advisors?
Yeah, for sure. So Dimensional Funds is a company that is not a household name. We are one of the largest asset managers in the US. Any given day, we manage roughly about $1 trillion in assets. And we are a very, very well-established firm in the industry. There are about 1,500 employees across the world, offices anywhere from Sydney to London, you name it, headquartered in Austin, Texas. And we do have a 40 plus year track record. But what's important, Eric, is that the reason that we are not a household name is because from day one we really had a purpose in working with a very limited number of folks. So the first thing that to know is that Dimensional has worked over the past 40 years either with consultants, large institutional pension funds, and so forth, or a very select number of financial advisors. And we never really promoted our funds. In fact, for the longest time, you could not buy dimensional mutual funds. Even today, you cannot buy dimensional mutual funds without actually working with an advisor. Because we do believe that these institutional advisors, these institutional consultants, that large institutions and certain advisors have a very strategic way of investing money. So we wanted to be very focused in working with them because ultimately the way that people move in and out of the funds has an impact on everybody else who's invested. And if you have hot money, bringing in $20 million today and then next week taking it out, well, that has a negative impact on everybody else. So we wanted folks who are much more strategic, disciplined investors, and that's what we've had. So because of that, we've never advertised. We've never kind of went out there and say, hey, individual investors, come work with us, which is very different than all the other competitors like Vanguard or Fidelity. They always try to bombard you as an individual investor, like, come buy my funds. We thought that the advisors have a crucial role in a successful investment experience. So that's one of the things that really sets us apart, is the fact that we don't have a retail mindset. Rather, we want to work with highly sophisticated professionals who in turn work with families. And because of that lack of marketing, not only that we're not a household name, but we've been able to keep costs very, very low and also manage situations like the financial crisis very, very differently. There was a time when so many individual investors were selling on panic, and it turns out that was a time when advisors were doing something that was quite remarkable. They would see that for a client who might have needed to have 50% of the money in stocks and 50 in bonds, when the stock market dropped, the proportion to the stocks also dropped. So at that point, what they would do is trim some of these gains and buy the stocks, which at the time were at tremendous valuations. And this idea of trimming the gains, taking some chips off the table, and buying something with better valuation, that has a name called rebalancing. And it could be incredibly useful to an investor, not only because you didn't miss out, but also you captured and had the ability to buy at a much lower prices. And that cannot really happen in a world that is driven by emotions, which is most investors. We do see them as being driven by emotions. And that's why we appreciate working with Aviator, because it's a very strategic approach to investing. So that's, we're very, we're very well known in this community, but not among the retails. The second thing that I think it's important about Dimensional to know is that from day one, we were not designed around star managers, which is quite often what the industry had promoted, particularly when you go back to the 80s. And rather than that, we wanted to have a very strong academic, not only affiliation, but a lot of academic, rigorous scientific insights into how markets work and how to think about portfolios. And because of that, from day one, Dimensional has been one of the most successful enterprises to integrate scientific research into the practical world of investing. And in fact, over the years, we have worked with five different Nobel laureates. And in fact, even today, a lot of the academics are the backbone of what we do. A much more rigorous scientific approach to investing rather than any one particular idea from any one individual. And that really sets us apart because nobody else in the industry has a very consistent philosophy that is based on research, not necessarily on opinions. And I think that's really interesting. And the third element that makes Dimensional apart, so is the way that we work with the investment public. It's the way that we are integrated with the academic community. And lastly, the fact that the strategies that emerged from this collaboration with the academics are quite distinct from the traditional Wall Street approach, which is around what stock do I own and the idea of what's called stock picking, but also different than the alternative that emerged, which is indexing. So dimensional is basically is the fertile middle ground when you are looking to outperform an index, but not using the traditional stock picking method. So I think those are interesting things, and make dimensional quite different. But I do have to say, Eric, that the one thing that we have not compromised, and we like all these things have been consistent. But the other big one is that we don't believe that investors should work with individuals who don't put their interest first. In other words, the financial industry for the longest time has been built on this idea of brokers. And the way that a broker gets paid is by selling you a product and getting a commission. And we don't believe that's the right way. The same way that a doctor shouldn't prescribe you something just because they get paid from this pharmaceutical company. And in that respect, Aviator and Dimensional, even though we're on this joint Zoom, it is not because there is a financial compensation that Dimensional sends Aviator. Not at all. Aviator works for you. They have, scoured the universe. There are about 3,000 mutual funds, ETFs, you name it out there, investment products. And they've decided that among all of them, Dimensional tends to fit the bill best today. If down the road that's not the case, great, we're gonna go look for somebody else. They can transition your assets into some other manager without missing a beat because again, they are not working for Dimensional, they're not being compensated for Dimensional, and that is what's called a fiduciary model where you have to put they have to put your interest first rather than ours. So I think that's really important to work with an advisor who has that particular way of doing business.
Let's just kind of go into some of the academic rigor. Just, it doesn't have to be long, but you have a PhD, and I see that many professionals at Dimensional hold PhDs in either economics or related disciplines. Could you describe what pursuing a PhD typically involves, and how does that research background influence Dimensional's approach to investing? And I know you covered that a little bit, but
Right.
I don't think that, I think that's so critical. It really is.
Yeah, it is hugely critical because the PhD in general, if I were to use one word to describe it, is precision. And what I mean by that is, if you wanted to pursue a higher degree, you can go to a master's. And I did end up going to a master's degree in economics and finance. And at that point, you have a choice. You can go in the world and do whatever you want to do. Or if you are really passionate about something, you really want to understand something at a very, very, very deep fundamental level, then you would pursue a PhD. And what's interesting about the PhD is that when you pursue that, you almost have to be self-driven by your interest in that particular subject. because there's nobody who will tell you this is the paper that you have to read. No, you have to come up with your own idea. You have to test your idea. You have to validate. So everything it has to be, for 5 years, all I did was just look at particular data that I was interested in. So you're kind of following your interest, and I think that's really remarkable. But the second thing is that when you come up with an idea, when you want to present something, you have to go in front of a committee and defend your dissertation at the end. And these are the utmost experts in that particular field. And I have to tell you from my experience, and along the way, you actually bounce ideas and they're part of this process. But at the end, you have to have everything incredibly buttoned down. Every single word, every number on every page, it has to be something that you understand and you can defend. And because they're trying to poke holes through it, they try to do all the time because that's their role. And I've learned that precision in understanding everything to the smallest detail is huge. And the way it reflects at Dimensional is that we have these academics that you saw, that are part of the investment committee. So when Dimensional wants to implement an idea into a particular fund, into a portfolio, well, the research group, the portfolio management, they have to go in front of this group, and it's being like in front of a dissertation committee, and they have to defend why is it that this makes sense. And you got to be ready to stand in front of, the utmost respected financial economists in the world who are going to try to poke hole at your idea and make sure that he can defend it. And only the most robust ideas will make their way into and be implemented into an actual fund. So I think that to me, at least because my own assets are invested with Dimensions, that there is a level of confidence that when something gets done, it's not something that's loosey-goosey. It's incredibly robust. It's incredibly well thought out, and it's vetted by probably the most reputable group of financial economists in the world.
So, similar to stock pickers, Dimensional's approach it seeks to beat the market over time. And you can break this question down how you want to, but can you compare and contrast Dimensional's approach to traditional active management? And then how in that approach does the track record compare to people that are trying to outsmart the market? We call it stock picking here, but people that are trying to beat the market.
So let's define these terms because it is a little bit jargon. The idea of let's say picking stocks and what it means. So let's take that this particular square represents all the stocks in the market, in the U.S. market, for example. And as an active manager, what's called an active manager, to traditional Wall Street active manager, a stock picker, what it basically means is that you start with a blank sheet of paper. You say, I don't, I just start with a blank sheet of paper, and then I'm going to sift through thousands of companies in the U.S. To find the ones that I think are the best opportunities. They have the greatest value. They're going to go up in value the most. I'm going to cherry pick those stocks and leave out everything else. And ultimately, on that piece, you're just going to cherry pick a handful of these stocks, leave out everything else, and believe that that's going to deliver a successful investment experience to an investor. That's the traditional model. It's just start with nothing, find reasons to add stocks in your fund. And the traditional model, it has an intuitive appeal. Like, why would I want to just hold the losers? Let me just hold the good ones. And what we found over time is that this might have made sense a while ago because really, the idea of selecting stocks is all around information. And whether it's how fast the information gets to you, whether it's how you process the information, and whether it's the quality of the information. So all of these were things that made a difference if you wanted to get involved in this type of management. But what we've seen, Eric, is over the past few decades, there was a fundamental shift in information. Today, investors can get information almost instantly. It travels incredibly fast. Secondly, the availability of information is almost overwhelming. Right now, you can buy, information about a satellite from a satellite company that launches these mini satellites to snap pictures of Walmart parking lots and count how many cars are in the lot. I mean, and decide if there are more this period than last year. all of this is available. So the information right now, it's almost overwhelming. But number three, the professional investment management has become really hyper competitive, not even competitive. There used to be the case that the majority of trades were done by individuals. You can make an argument that maybe you can pick their pockets, but today the vast majority of trades are done among professional investors. And just to give an idea, there are more professionally managed funds in the US than actual stocks trading on the market. So in that respect, the notion that somehow you can cherry pick these investments and you can select the right ones and consistently pick the pockets of other folks is no longer legitimate. And the data that we see, whether it's from the S&P, which they run a study, we've done some work, what we see is that over a 20-year span, for example, the vast majority of these funds underperform the market, partly because of the fees that they charge. They're pretty high fees. So this way of doing business, it's a little bit like Blockbuster Video in the age of Netflix. It's had a moment in the sun, but it's no longer what it used to be. And the alternative to that emerged in the 70s when the idea was that, and this is where Dimensional basically started and pioneered, the founders of Dimensional pioneered this idea that, listen, the markets have changed, the world has changed, and there might not be anything wrong with these stocks, so we might want to consider holding them. But instead of trying to cherry pick this, the fundamental premise that we started with was the idea that, hey, what if you try to understand not these stocks by themselves, but rather these stocks as part of a larger group, a larger basket of stocks? So, what computers and data allow researchers, academics, and practitioners to do is collect much larger baskets of stocks, analyze them, and at that point, you're not interested in the behavior of any one stock, but the behavior of the group as a whole. And probably the closest analogy, Eric, that I can think of is that if you look at a school of fish, every fish moves randomly, up and down, left, right, sideways. Nobody can predict how each fish moves. But if you observe the school of fish, you start to capture and understand the behavior of the entire school of fish with a lot more precision than any one fish. And I think that's exactly what this research has allowed us to do is do research at a larger scale, not an individual company, but that company as part of a larger basket. So in this, if you want to think about this way of thinking, is that the version 1.0 was this idea of stock picking. The version 2.0 basically emerged with the idea of index funds, because index funds buy these larger groups of stocks, and this is conventional Wall Street. This is index. So this is a version that really showed much more promise, because buying a group of stocks it kind of gives you a way to spread the risks and actually delivers better performance than these managers when you look over longer periods of time. So that was the idea that the day two came when you had the index funds. And to me, index funds are a better way to invest than the conventional Wall Street. It just, you leave money on the table, because in the world of an index fund, they don't really care. They don't have an investment philosophy. What they really cared about is, I would just want to replicate a list that is provided by a third party, and I wanted to do it at a low cost. Those are the two things that they care about. And to me, it's better than the conventional Wall Street, but because you are just simply blindly and mindlessly following a list created by a committee, like the S&P committee with the 500 stocks in the S&P 500. You have no choice. All these index funds have exactly the same S&P index because they all do the same thing, license the same list, and blindly and mindlessly replicate it over and over. So what Dimensional came to do is like, is there a better way to do it? And that's what I do believe, that Dimensional is almost like a version 3.0 of investing, where you're trying to go beyond indexing, but in the same vein of looking at these basket of stocks. And this is where kind of where we see the evolution, and we kind of think it's a little bit beyond indexing. So the first thing that you do to go beyond indexing is, well, if you have all these academics, why exactly do you need to license a third-party list? We don't need to license that. We can create our own list and control our own destiny and not be forced into trades just because the committee decides to release a stock from the list or add one to the list. That's the first thing. The second thing that allows you to do is look at the market a little bit differently, because if you look at the US market, I mentioned, let's just look at the square. You have these companies in the S&P 500, and these are the large, what's called large companies. They're large, mature, well established. But in the US market, what research showed way back in the early 80s was there's a group of about 2,000 smaller companies that are not as big. So think of large companies as a poster child as being McDonald's. And that's great. So large, mature, well-established company, long track record. But in the US market, there's also a publicly traded stock called Shake Shack. And that's a much smaller burger chain. And if you ask, well, which one of the two can grow and double in size easier? Most people would say McDonald's, Shake Shack. On the other hand, McDonald's is more robust, again, longer track record, and people feel more comfortable with their track record. So from an investment perspective, what we realized is that most investors were just buying this S&P index, which is large companies. And we have a book, and it's one of my favorite books. It's called the Matrix book, that has data going back almost 100 years. And you can look at a growth of $1 in these different investments. So if you look at the S&P 500 index, almost 100 years of data, $1 invested in the 20s would have grown to about $18,000, which is an amazing growth, Eric. 18,000-fold increase, pretty much in my dad's lifetime. But if you had invested the same dollar over the same period in smaller companies, that growth would have been closer to about $54,000 as you look at the Dimensional Small Cap Index in the Matrix book. So it's really quite interesting that by paying attention to small companies, you can actually improve your results. So not saying that the S&P is not a good idea. It's just that, hey, listen, there are also some smaller companies which are not covered in the S&P. And in the 80s, the question was, what about all the large and the small companies? Are they exactly the same? And what became apparent is that there's something that's called price and valuation. And what it basically means is if you buy a home, there's a house that sells for $2 million. Great, not for $2 million. That doesn't mean anything. You have to do it per square foot. So you have to measure relative to something. And if you look at the price of a stock relative to earnings or the value of their assets, what's called book value, the companies that have a relatively low price, they're called value stocks. And over the long run, they outperform the more expensive counterparts called growth. So if you knew that value outperforms growth, small beats large, the one part of the market that ought to give investors the biggest bang for the buck over the long run is both small and value. And if you look in the Dimensional Matrix book at the small cap value index, what you see is that the same dollar over the same time period would grow to about $166,000. So quite significantly more. So the idea being here now that if you are an investor, now you have a primer. You have a primer that tells you that if you look at the U.S. market and you just buy only the S&P, great, you just bought this particular portion. To the degree that you're willing to emphasize value companies and small cap stocks, then you're giving yourself a chance to earn a higher return on your money over the long run. And I think that's the really interesting, important thing here is that what we find is that it's not just not following the list from an index, but what if in our funds we cover the entire market, so you're not missing anything. But in some of these funds, we decide that listen, we're gonna have growth, but what if we emphasize a little bit more small and value? That is what's called a tilt, and we do have that. We also give advisors like Aviator specific funds around large and small value growth, and they can build those specific portfolios for you. But again, it's the idea that you're trying to do better than the S&P index, not by picking stocks, but being purposeful in the way that you reshuffle the deck and you emphasize these groups of stocks that have a higher potential for growth over the long run.
Apollo, this sounds too good to be true. What's the catch?
Yeah, it's a good question, because if I saw these numbers, first of all, why not put all the money in small value? What's the catch here? How come more people don't do this? And I think this is a really important element to know is that this is a very scientific, this is a very data-driven approach to investing. And if you hear something like this, I mean, the first thing is like, well, I expect to see next month when I meet with you, I expect to see small beating growth and value and small beating large and value beating growth. So the expectations that investors have is that this is going to happen all the time. And that's our expectation too. Every time you're going to see this. The reality of the matter is that, I can expect to be snow in Colorado in any one January, but it's possible that sometimes I might not see snow. But the expectation is that I see snow. And if you want to think about this way, when you look at the data of these, what's called premiums, the difference between large and small value and growth, what you see is that historically, when you look at value beating growth, for example, it was a big difference. But on an annual basis, only about 59% of the time, so about 60%, 16 10 years, you see value beating growth, which means that about 4 in 10 years, growth will beat value. And that's not trivial. That's actually not far from a 50-50. So on an annual basis, I still have better odds to see value beating growth. And yet I also know that about 40% of the time I will be disappointed. Now, if I give this system more time, what's remarkable is that the odds improve. And that's the way that we look at it. It's all about odds and how do you improve your odds. If you work out and eat healthier, there's no guarantee of a longer lasting life. It's just improving your odds. It's the same here. It's like, when you look at 1 year, it's about 60% of the time. When you move to 5 years, that's about 70%. So the question is, if you're an investor that sees that 70% of the time or so after 5 years, value beats growth, which part of the market will you choose to emphasize? But again, the thing is that you have a potentially a 5 year period when growth beats value. And that's what the issues that we've seen is that a lot of investors, when they see, oh, a year has gone by, 2 years is not working, I need to shift out of it. I need to do something else. That's when the discipline breaks down. And that's why we think that having a financial advisor who can balance all these different parts of the market, but even more importantly, can make sure that you're not making the wrong behavioral decision is crucial. It's absolutely crucial. And we see this over and over and over again. People say, I'm going to give up on this because look, it's been 2 years and it hasn't worked out. We expect that to happen, but if you don't have that backstop to that behavioral element, it becomes very hard. And if you give more time, if you look at 10 years, for example, once again, the odds improve. But even after 15 years, you don't really see the odds as being 100%. It's very similar to small cap. So you have to manage your expectations. You have to have an advisor who is disciplined enough to make sure that you're not really abandoning the strategy at exactly the wrong time, because we've seen this over and over, and that's what I think it's crucial to work with an advisor, not only to know how to build this, but to also be able to stay disciplined and not miss out. Because the expectation is there'll be times when I won't see snow in January on the slopes in Colorado. That's fine. It happens. But my expectation is still that's going to be a snow town at some point.
I like that snow analogy, and I like, what increases your odds. And, when it comes to increasing your odds, increasing your probability of success, since this value research, are there any other research, or is there any other research that has emerged?
Yeah, and that's interesting because about 10 years ago, a new line of research emerged that basically looked at small and look at value, and they say, well, there's perhaps a third component to this that you need to consider, which is a company's profitability. In other words, what we found in the research is that companies that are unprofitable, they tend to stay unprofitable for years down the road. And the ones that are profitable, they continue to stay profitable. So the idea is that, first of all, you have to define what profitability is. And we have worked with these academics to define exactly what profitability is. But secondly, it kind of gives you an idea that the companies that are profitable today, they actually can generate higher returns because they're better at looking at their balance sheet and squeezing more out of their assets. That's a very intuitive way to think about it. If you have a company that is very good about squeezing every dollar in profit from the asset and others that are not, that's in a very high level intuitive way, profitability, that's what it's trying to look at. So to me, we have incorporated this additional element of profitability, and it's not necessarily additive. Is you can say, well, I want to add small, I want to add value, high profitability, and pile them up on top of each other. It's more about the just how consistent the outperformance can be. It's almost like if you have an elevator and it has one cable, well, that's a little dangerous because you only have one cable. If you've got another cable, if one doesn't work out, well, the other one might hold, but now you have a third cable to the elevator. So what we see is that at any one moment in time, the probability of none of these working is very low. So that's kind of how we look at it. Is it basically increases the reliability of that outperformance rather than piling on top, on top, on top, which I think is really important for most investors.
So the elevator example is awesome because we have an elevator in here, so I like that a lot. And when you're increasing your odds and you're adding the elevator cables, you talked about adding small in value, in profitability, and not relying on a index list of stocks, but Dimensional's created their own with their mega research institution. And we've been talking a lot about US. What about the rest of the world? What about some of the international developed and emerging markets?
Yeah, and it's so interesting, Eric, because if you look at the world, I mean, it's quite remarkable. The U.S. In a global perspective, we are only about roughly about 4% of the global population, and we're about 6% of the global landmass. We're not a huge territory. We don't have tons and tons of people compared to other countries like India and China and so forth. But what it is incredible about the US is that even though we're 4% of the global population, 6% of the landmass, we have roughly about 26% of the global economy. So more than a quarter of the global economy comes from the US. Now, when we think about the economy, that's the value of everything that gets produced in the country at this moment in time. That's the economy. The stock market is not just reflecting that, but also the opportunities that companies have for years down the road. Because the stock market reflects the value in ownership. If you buy a share of Google or UPS, or you name it, you basically buy not only in the value of what's being generating profits today, but also for years down the road. And what's remarkable is because the US companies are so large and dominant across the world, when it comes to the value of the US stock market, it is not 26% as the value of the economy today, but rather it's a whopping 65% of the value of all stocks around the world. There are 3,000 companies in the U.S., and the U.S. is about 65% of them. So we are the largest stock market in the world by far. The next biggest one is Japan at 5%. But what it also means is there are over 10,000 different companies abroad in which you can participate in their ownership. So is it worth doing it? And to us, absolutely. And the first one is just an intuitive way of thinking because, Eric, if you say, all I want to do is buy US stocks, they're great companies. And that means if you look at, let's say, car manufacturers, you're going to own Ford, GM, Tesla, great, great, great companies. That's fine. At the same time, when you look at the streets of whether it's Nashville, whether it's Kentucky, whether it's California, whatever you go, you're also going to see some Mercedes, some BMW, Porsche, VWs. Those brands are owned by companies that trade in Germany. Even great American brands like Jeep and Chrysler, they're owned by an Italian company, Stellantis, that trades in Milan. We're all familiar with the Japanese car companies, the Hondas, the Toyotas. Ironically, great British brands like Land Rover and Jaguar, they're owned by an Indian company today. Volvo's a Swedish company that actually that brand is owned by a Chinese company. BYD is the largest makers of EVs in the world. And you have the Korean shops that are making inroads. So the intuitive question here is that, yes, I absolutely want to own Ford and GM, but why not consider BMW, Toyota, and Jeep for that matter? Because that is international investing. You're not buying in countries, you're buying in companies. And I think that intuitively to me makes a lot of sense not to limit yourself only to the US. So that's the first answer is I think there's an intuitive appeal. Secondly, what we see is that the same exact dynamics that we saw in the US with the delineation between large, small, value, growth, profitability, high and low, they apply abroad. And there are years when these particular markets, like international markets, they're just shooting the lights out and flying so high. They're doing so well. And it's not even just the market, it's that within that market, you have a particular value. You have a particular small company. And that was the case exactly like here, that international value, for example, shut the lights out relative to everything else. So it's good to have exposure to that. Now, the key to this whole thing is that you have to have exposure before these great returns come. And over, what we see is that people, try to get this exposure after they saw the great returns. And I've heard so many people asking me at the beginning of the year who are not invested like you with Aviator, asking me, should I buy international value? I was like, you should, but you should have had it before it went up so much. So I think it's really crucial to look at international, including these dynamics that we talked about, small value, but have them consistently and systematically in your portfolio. And what happens over time, which is really important, is an advisor would have a certain mix. They would say, I want to have this much in US large, US small, international, small, value, emerging markets, and puts together this puzzle. And if any one investment start climbing and climbing and climbing, and it's doing great, at that point, it's smart to trim these gains, take some chips off the table, and then go buy something that has perhaps a better valuation. And that process is very systematic, and it's called rebalancing, and it can add tremendous value, both in terms of capturing returns, but also managing risk.
Yeah, that's true right there. We see it in real time. And thank you for giving us those examples as for international companies and US companies, because you just made it real for clients. I mean, in any room I go to, when I talk to clients, I'm always like, we're representing probably dozens of international and US companies just in each room, to the clothes that we're wearing, to everything around us.
Yeah.
And that's great. So the last question I have is, it's hard to rebalance. It's hard to do all these things. It's hard to have all these exposures, and there's a cost, but there's a net return. And so how do you execute this into a portfolio if you're not doing it in some type of index fund?
Yeah, and I think it's really important to understand the dynamics and even to some degree very quickly what's the background of an index fund. And obviously everybody associates indexing with the first company that brought it to the masses, and that is Vanguard. And I think it's just a tremendous respect that we have for Vanguard for really democratizing investing and introducing this idea of a diversified way to invest to the average folks. What's interesting is if you actually dig a little deeper into this, is that the premise of indexing was based on the fact that Bogle, who was the founder of Vanguard, basically had an issue with his partners who were picking stocks, and he was picking stocks, but they were kind of prohibiting him from. They fired him from the firm, and they say you cannot be an investment manager. You cannot actually select investments. We'll let you do the administrative part of running a fund, which is like all the stuff that nobody really wants to do. And Bogle really wanted to still be involved in investments, not necessarily just the admin work of a fund. So long story short, what he found was a loophole, and he said, well, if I go to the S&P and I license that list from them, I don't really care about the list. It's just the fact that it's put together by a third party. And by licensing it, I'm not actually selecting investments myself, which I'm not allowed to do because of this contract. So what he really wanted is to lower the fees. He really thought that lowering the fees would help investors. And we absolutely have the same belief that lower fees in a fund are a good idea. And that's why Dimensional and Vanguard are very similar in the fees that we charge. But what's interesting is that it was never driven by any investment philosophy. It was always driven by this idea of there's one factor that matters, one single factor that matters, which is the lowest cost out there. And over time, what we found is that that is important, but there are other things that matter. And I travel a lot, and one of the things that I've learned is that I'm not going to select the hotel based on the cheapest rate. If I find in one hotel and I say, oh, this is the cheapest rate by 20 bucks, I'm not going to jump all over it and say, oh, this is the cheapest, because I don't shop for the cheapest sushi in town. I don't go to the car lot and say, show me the cheapest car. What I want is the best value. And quite often what you're doing is, even though it's the cheapest room, for example, in a hotel, when you compare it to somebody across the street who might be like $5 more, well, you're gonna get a free breakfast. You don't have to pay 50 bucks for parking. You're gonna get access to something like a gym that the other one doesn't. When you pile it all together, the value that you get from something that might be a little bit marginally more expensive is tremendously more than the cheapest. So our goal at Dimensional is not to be the cheapest, it's to be the best value. And in that respect, what you mentioned, it really matters. So costs, we're very, very, very attuned to costs. So we're very similar to Vanguard. On the other hand, there are other costs of investing, like transaction costs, like buying a stock when everybody else has to do it when it gets added to the list. We don't want to put that on your investor. Being flexible and not having to trade any one day because we have substitutes that we trade depending on how much liquidity is in the market. So there's so many levers that we can pull, and that flexibility that we have is a tremendous benefit relative to just mindless replication of lists and sole focus on fees, 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 fees. Again, I mean, if you want, go buy the cheapest sushi in town. I mean, we believe in value. We just don't believe in being the cheapest. We want to be the best value. And there are a lot of activities that he can do in that pursuit. This way of investing would not be reasonably accepted as successful unless there is a financial advisor. It's a very sophisticated way of investing. It has a lot of data. It requires rebalancing and understanding the different dynamics among all these groups of stocks around the world.
We really appreciate your time, Apollo, and thanks for taking the very, very complex and making it very understandable and giving us real world ideas with this. And it's all about the execution, and that's what we're here for, is to help our clients execute with your help. So we appreciate this, and thank you, Apollo.
Thank you for the trust and the partnership over the years. Even though it's a financial partnership, it's more of an alignment and philosophy. But thank you so much for the trust that you and your clients have put into Dimensional.